Hi, everyone, and thank you for joining us. I'm excited to welcome Jay Mintzmeyer, who is a renowned maritime shipping analyst who directs the Value Investors Edge research platform on Seeking Alpha. He's a frequent speaker at industry conferences, is regularly quoted in trade journals, and hosts a popular podcast featuring shipping industry executives. Mr. Mintzmeyer, thanks for joining us. The floor is yours.
All right. Good morning, everyone. Welcome to Money Show Virtual Expo. I'm happy to be with you today. We've been doing these about once a quarter over the last year and a half or so. So I'm happy to join you once again. I'm on Twitter at Mintzmeyer. You can follow me there for free. We also have research free trials available for 48 hours at mintzmeyer.com. Before we begin, I'd like to start with a performance review. I mentioned we've been on Money Show now for almost a year and a half. Each time I come on, I like to look back at the top picks that I made the time before, just to see how they've done, keep ourselves accountable and see how the stocks are doing. The previous Money Show clips are available. Money Show has a YouTube channel. I do as well. And you can go back and see the thesis and the top picks in each one for each quarter. So the first time we were on was last August, outsized return potential in maritime shipping. The average return of those 5 picks was 38.5% in 4 months. We outperformed the S&P 500 by 26%. Why do I say 4 months? Well, that's because 4 months later, we were back on Money Show with new picks and new theme. The average return of those 5 picks was about 39% in 4 months, outperformed S&P by 28%. Next turn, last April, 16% in 3.5 months, outperformed by 8. And last July, we had a 37% return in 3 months, a blistering return into the fall, outperformed S&P by 32%. And then last time I was on was October, maritime shipping profit from the supply chain recovery. And to hold myself accountable, we were basically flat, down about 1% over the past 2 months. We were hit a little bit by that small cap volatility. If you look at stuff like the Russell 2000 or especially stuff like the ARC ETF, you'll see that's down about 25% over the last month or two. So that hit shipping a little bit. We underperformed by 6%. So going forward, we'll continue to post those updates. But as I hope you can see, it's been a very good year for us. So today's focus, I'm going to talk a little bit about our research and our background and what we bring to the markets. We'll talk about what happened in 2021, how the markets have been so far, the overall macro setup for next year, which is already December 9th. So we're already really focused on 2022 by this point. And then I'll talk a little bit about the 3 main sectors, container ships, dry bulkers, and tankers. And then I want to leave some time at the end, hopefully about 10 minutes for Q&A. So you think of any questions along the way, feel free to post those in the chat or jot them down to yourself, and you can post them later. And I'll try to save at least, the goal is 10 minutes for Q&A at the end. So first of all, I want to talk about who we are and how we outperform. Value Investors Edge is a boutique research service. We're hosted on Seeking Alpha, but it's an independent service. It's available for anyone who's a trader, investor, family office, hedge fund, whatever you might be. We can cover your research interest in shipping and related trade infrastructure. We stay completely in our lane. We only focus on shipping and related energy infrastructure. That's all I do. That's all our macro guy, James, looks at. Michael Boyd is on our team. He does the energy stuff solely in his lane. And then Clement's our associate, again, only in shipping. We don't get distracted, so don't ask me anything about Tesla or Bitcoin or anything like that. Our performance year to date 2021, it's been a great year for us. Our speculative model, which is only stocks, no leverage, no options, nothing crazy, no margin. It's up 193% year to date. That's as of last night. So it's almost a 3x year to date. And our risk reward, more of a value model portfolio, is up 79.5%. Again, stocks only, no leverage, options, nothing like that. Pretty easy to follow. This is a chart that shows you. You might say, well, Jay, shipping's had a great year. Of course you had a good year. Well, that's fair. Shipping had a good year. But if you look at the pink chart here, you'll see shipping's up about 50% year to date. And our models are up 136% on average. The Russell's only up about 15%. So significant outperformance. The stocks you select do matter in shipping. Again, this is a 6-year chart. And why, Jay, why is it 6 years? Well, that's because Value Investors Edge was launched towards the end of 2015. This is the full performance since we've had a research service and platform. You can see on the far right here, the shipping industry average over the past 6 years. If you came in here thinking, shipping's not a space I really want to be in, I've heard people don't make money there, it's tough. That's correct. In the last 6 years, the average shipping return has actually been about -1%, basically flat. If you would have been in small caps, you would have made about 14% per year, S&P 500 about 17%. But if you look over here on the left, this is the Value Investors Edge return. We're up about 41.3% annualized. That's per our trades and model portfolios going back to 2016. You can see in 2020, we did have a loss, a negative year, -6.8% in 2020. We're never happy about a loss. That was the only year, 1 out of 6, that we underperformed the market, S&P 500 and Russell. However, I want to direct your attention to the shipping industry, which was down 36.2%. So even in that tough year in 2020, we provided about 30% of alpha in our sector, and we only do shipping. And then this year, at a good year, we did 136%, providing 80% of alpha. So 30% of alpha in a bad year and 80% of alpha in a good year. With that said, that's enough about us. I want to talk about the overall broad market and some of the macro trends today. So first of all, I want to talk about the story of 2020, what happened with COVID. COVID decimated, just totally destroyed shipping stocks. Ironically, the underlying fundamentals were strong in shipping. Balance sheets were stable, cash flows were steady, the markets quickly recovered, but the stocks didn't. Unlike the broad market, which had that big recovery trend in March and April when all the retail money plowed in, we didn't really see any recovery gains until September or October of last year. Even though most of the shipping stocks themselves, the companies, were fine, were stable, were generating strong cash flows, the equities didn't really start moving until Q4. In fact, even last December, mid-December, only 4 out of the 55 stocks we follow in the industry were positive. It means 93% of the stocks in shipping were losers throughout most of 2020. So that's pretty devastating, even though the companies did fine. Now, the story of 2021, what's been going on this year, has been the opposite, the shipping stock recovery. Remember, we were at those basically all-time record low valuations in 2020, starting from a very easy floor there, and those fundamentals remain strong. In fact, they were stronger than even I anticipated. Container ship rates hit all-time record highs. Dry bulk rates hit 11-year highs. There's a global energy crisis ongoing in both Europe and Asia, which is helping the gas transport rates go higher. As of yesterday, 35 of the 53 stocks we follow in the industry are positive. It means about 2/3 of the stocks in 2021 were winners. Of those 35 winners, 11 of them doubled or better, and 5 stocks were triples or better. And in our models, we were lucky enough to have a good portion of those 2 and 3 Xers. So that generates a strong performance. So again, it was a good year for shipping, but stock selection is still important. If you just randomly bought a bunch of stocks, 1/3 of them somehow lost money this year. Now, what's the setup for next year? Like 2021 is basically already over. So the valuations are still near the record lows. And you might say that's weird. Why are you saying they're at record lows? You just told me that 2/3 of them are positive this year. Well, that's true that they're positive, but they've generated free cash flow all year long. They've paid down debt, and they've signed long-term contracts on a lot of their business. So the actual valuations, whether it's price to NAV, price to earnings, price to free cash flow, enterprise value to EV, EBITDA, whatever multiple you want to pull out of your hat, the valuations are still near all-time record lows. So businesses have gotten better, but the market improvement has outpaced the stock price. It's like the multiples have actually went down, which is really fascinating. The balance sheets in shipping have never been stronger. There's a misconception I hear a lot that shippers are over levered, they're risky, they're so on. Well, there are some risks in the market, but it's not financially. The leverage across almost all the firms we cover is the best it's ever been. There's a few that are too high levered, and we stay away from those. Also, the corporate governance has improved a lot over the past decade. There was serious corporate governance problems in shipping 10 years ago, certainly. And there still are some firms out there that I don't trust, I don't want to invest in. They stay out of our model portfolios. Some of them we just don't even cover at all. If you ask my opinion, I'll just say, look, we don't even talk about that company. But on a risk reward basis, my personal belief and opinion is that 2022 looks even better than 2021 did last year. And we did 136% this year. So am I telling you that we're going to beat that this year? No, I don't believe so. We might never see 136% returns ever again. And that's a life-changing type of investment return. That's a 5 or 6 or 7 year type return and compressed into 1 year. Now, when I say risk reward, I mean the downside. I mean the risk, the negative factors are way lower than they were a year ago. The balance sheets are way cleaner. The fundamentals are way stronger. So I don't think we're going to get more return. I don't think we're going to do 136% again, but I think 50, 60, 70% return is definitely on the table. And I think there's much less downside. So that's how I approach the markets. I always do a risk reward factor in my stocks. So a little bit of macro tailwinds I want to talk about, 3 of them before we shift to the segments. First of all, is value investors returning to the sector. A lot of value investors left around the COVID time period. A lot of value investors are still skeptical. They're seeing stuff like, for example, ARC, innovation ETF, things like that, and they're skeptical of market valuations. However, shipping is in a league of its own, and energy is kind of similar. The valuations are very cheap, and value folks are starting to get interested again. We have a very promising forward supply and demand setup. I'm going to cover that a little bit more in the segments. Secondly, surging underlying free cash flows and shareholder returns. As I mentioned, the average balance sheet's the strongest it's been basically in all time, but certainly since I've been covering shipping for the last 12 years. And we expect significant dividends and repurchases across the industry. In fact, of the companies we follow, at least half of them have a very clear variable cash flow payout policy, or they have launched a repurchase program, or they have significantly raised their fixed dividend. So one of those three things, over half the companies we follow have already done one of those three. Finally, inflation, or some folks call it kind of a reflation trade. I'm not a huge proponent that we're going to see huge, massive inflation. That's not my personal take. But for those who do desire a inflation hedge, I believe shipping is phenomenal for that. If we have high inflation, the rates and the vessel valuations will rise. Meanwhile, the value of fixed debt and hedge debt will go down. So you think about rates rising, debt going down, you get that exponential net asset value and earnings growth in the middle. So shipping, I'm not saying buy shipping for inflation. That's not necessarily my pitch or my belief. But if you're concerned about inflation, then shipping makes a great hedge for, I think, part of your portfolio. So today we're going to pivot a little bit and we're going to talk about three segments: container ships, dry bulk, tankers. We'll spend about 10 minutes here and then we'll pivot back to the Q&A. So if you have any questions about the segments or our overall approach to the market, again, feel free to throw those into the chat. So starting with container ships, the theme here is global restocking against these logistics bottlenecks. The global demand we're seeing is far exceeding available global tonnage. This is a classic economics 101 supply and demand mismatch. There's more demand than supply, which drives up prices. Now, congestion and all the little bottlenecks we're hearing about are turning what should be a strong market, very strong market, into like a hyperbolic, massive exponential market, right? Without the congestion and logistics bottlenecks, the rates would not be as high as they are today. However, some folks misunderstand and they think, oh, it's all artificial. No, this is an underlying, very strong market. It had already started recovering in Q4 19 and then got disrupted a little bit by the onset of COVID. And now we're just seeing that natural supply-demand mismatch play out. We're also seeing additional disruptions and bottlenecks. We have Omicron shutting down some Chinese ports. There's rumors that we're seeing another port shutdown this week. Remember what happened last time when they had the Delta port shutdowns? It gave about a 2-week lag, 3-week lag, and then massive congestion again in LA and Long Beach. So we're very interested in that. We see that as bullish. And then early next year, there's a huge labor union renegotiation upcoming. These happen once every 5 to 6 years. Now, the labor union's in the strongest position I believe they've ever been in. The shipping rates are high. Americans are aware of the supply chain. Businesses are desperate to get their goods through. So the labor union, naturally, as they should, logically from economic perspective, bargaining perspective, they're going to want more. They're going to want higher, benefits. So last time this happened was 5 or 6 years ago, and we had port shutdowns for several days. One of them was rumored to be shut down for several weeks. This year, it could be even worse. So that would even add to the congestion. Now, that's the labor renegotiation is for sure. We don't know what's going to happen with port shutdowns and whatnot, but the odds are, historically speaking, that's going to add to congestion. The best part about all this is that our companies, the ones we're investing in, are getting fixed contracts for 3 to 5 years on most of their fleet. So it's not just like a spot trade. It's not like, oh, we got strong rates today, but next quarter they're gone. No, they're signing 3 to 5 year leases on these ships. So our top pick for containers is a company that trades at less than 2 times next year's earnings, once you exclude their cash and cash equivalents, and that's Danaos Corp, DAC. So you say, okay, the rates are really high. They're not going to last forever, but they're signing 3 to 5 year contracts. So you'd think at least at a minimum, it should trade at 3 to 5 times price to earnings. No, it trades like 1.8 once you strip out the cash and stock equivalents. So, just on that alone, there's anywhere from 50 to 100% upside just on a common sense valuation normalization. Some other firms, Atlas Corp, Costa Mare, Global Ship Lease, and Zem. We'll talk about Zem a little later as well. So overall in the industry, we've seen strong consolidation over the past decade. We're not to, like, I would say oligopoly or even definitely not monopoly status, but we're to a place where there's enough consolidation that keeps rationalization in the market. Think about how global airlines have changed over the past decade. Global airlines used to be a terrible investment. They went bankrupt all the time. They couldn't control costs. And now airlines are one of the strongest businesses in the world. And that's something we're seeing similar in this industry. This is a 1-year chart of the leasing rates. These are the rates that companies like Danaos Corp will get when they fix a ship for 1 year. You can see they topped out in October of this year, which is seasonality. Seasonal market's always the strongest, September, October. It topped out in October, but you can see they're stable. it's not plummeting. It's actually stabilized quite quickly, which is actually surprising. I would have thought it would be lower to here by now. And keep in mind that these are 3 to 5 year charters. So Danaos Corp signed some here, they signed some here, they've been signing them here, they're signing them now. So if these rates come back down, those are going to impact results in like 2025. So that the near term results are basically fixed and only going upwards because of the slope. The slope, it's like a big lag, if that makes sense. So the results in 22 and 23 are going to be way higher than 2021. These are the average global freight rates. This is what it costs to move a 40-foot box from, say, Asia to the United States, Europe to the United States. This is a global average. You can see they peaked around September, October. This is seasonal. It happens every year. The peak freight season is basically August through like mid to late October is the peak freight season, because the shippers want the goods before Black Friday. They want the goods before Christmas. And then once you get to like December, it's too late. I mean, now with congestion, if you're shipping a good right now on December 9th, which that's the quote today, December 9th, you're not going to get that stuff until you're probably too late even for Valentine's Day. I mean, we're talking like St. Patrick's Day or Mother's Day or something. So the fact that rates are holding here is remarkable. I mean, they should be down by 40% by now. So when folks look at this chart, they get the wrong takeaway. They're like, oh, rates are easing, they're down 10, 15%. That's kind of the wrong takeaway. You got to look year over year. You got to understand this is a seasonal chart. If these rates don't drop, and they might, I would expect them to go lower. They should. It's seasonality, it's common sense. But if they don't, if they hold at like 9,000, and we get over here to January, February next year, and it's at 8,000 or 9,000, what do you think is going to happen when we come into the seasonal run for restocking? I mean, it could be off the charts, and we're not there yet. But if you're looking at this chart and you're not bullish, I don't know what to tell you. Finally, misleading stats from politicians. When have politicians ever been misleading? But the news flow is awash in supply chain easing headlines. And recently, we've heard about massive reduction in ships off Long Beach and LA. And the funny story is this is due to sleight of hand. It's not even true in terms of the congestion levels. Let me show you an example. About a month ago, LA and Long Beach shifted to a new system where ships have to hold 150 miles off the coast. It's for environmental reasons, or you might even argue some political reasons. So the red reflects the new system, the blue reflects the old system. So politicians and folks who want to be upbeat and optimistic will point to this blue and say, look, the ships anchoring have plummeted. But you can't do that. You got to look at the new system and calculate these together. And that's what the red and the gray show you. We're actually at all-time highs in LA and Long Beach congestion. So if someone tells you that things are getting better over there, they're just not looking at the right data. The second thing to look at are the long dwell containers. Now, this is something LA and Long Beach have focused on heavily for the last 2 months. A huge problem. These numbers should be like 10,000 normally. And you can see they're about 35,000 to 40,000 in late October, early November. Now, you'll hear a lot. They'll say we've reduced these counts by 40% and so forth. And that's true. And they're doing a decent job. And that's good. They should. And it's good for them. But what they don't tell you is that progress has stalled in the last 2 weeks. And in fact, it's gotten worse over the last 2 weeks. So all the low-hanging fruit was picked, and now we're just kind of stagnant here. And if you look at throughput, port throughput, it has also plummeted. And if you look at the congestion on the water, it is at all-time record highs. So it's kind of like robbing Peter to pay Paul in this scenario. And it's not even working. It's stagnated. There's a lot on container ships. You can tell that's the sector I'm most interested in. Dry bulk, what we like about this is the global infrastructure mixed with the tiny order book. As the world continues to reopen post-COVID, we expect there'll be a lot of infrastructure spending. The United States is really just the tip of the spear there. That's going to lead to increased demand for iron, copper, cement, and other things. Also, dry bulk shipping has the lowest order book in modern history. So supply isn't going up at all. If demand goes up, you know what'll happen to rates. It'll be almost like container ships there. We expect significant surges in trade flows throughout the next 3 years, 22 to 24, based on mostly infrastructure, reopening, that sort of spending. Our top pick in dry bulk is focused on the mid-size ships. We believe the mid-size have the best backbone in the markets there. It's Eagle Bulk, EGLE. It's US listed, US management. Gary Vogel is the CEO, very trustworthy. They've done a great job over the years. Some other firms, Genco, Golden Ocean, Synergy Maritime, and Star Bulk. Now, this is the BDI, the Baltic Dry Index, and this is the overall market of all dry bulk ships. You can see it looks kind of like lumber. It looks kind of scary. It peaked out and had this big crash. Well, again, this market is seasonal. The seasonal peak is always in the fall. The weakest part of the year is December through March. So it's actually kind of weird to see like a rise in this case. Secondly, you got to look at the underlying market, what's going actually on here. So China is trying to improve their environmental levels ahead of the Olympics. That makes sense. And every winter they try to do that. They try to cut back on some of their smog production and stuff like that. Smog is more noticeable. Pollution is worse usually in the winter. So they try to curb back their factory production, their industrial production. They're also going through an energy crisis in China. They have a huge shortage of coal. And it's not just China, it's India, it's Europe as well. So they've actually issued mandates to a lot of their industrial players saying, hey, you need to curb your imports, you need to curb your production for the next month or two and allow thermal coal for power plants and heating to take priority. So there's been a decrease in met coal, metallurgical coal, and there's been a decrease in iron ore as they're focusing on that area. And of course, the elephant in the room, the Evergrande property situation. So you add all those things together and you totally understand why there would be a decline. However, we're also want to looking at the mid-size rates. The Cape size is very volatile. It's always been volatile. It's focused on iron ore, a little bit of coal, and that's the heavy component of the Baltic Dry Index. Meanwhile, if you look at the smaller and mid-size rates, you can get a better barometer of global health. So I want to do that real quick. We'll look at Cape sizes and very volatile. It looks like the BDI, Baltic Dry Index. You can see kind of a crash here and a slight recovery. But if you look back, yeah, they're 5-year highs. But if you look to the trough rates or even rates today, they're not unprecedented. I mean, we saw these rates last year in 2020. We saw them in 2019. We saw them in 2018. These rates are not unprecedented. They're strong, but it's nothing to really get excited about. If you look at the mid-size, more of a barometer of global health, you can see that quick bounce off the bottom, like almost like one-day bounce, like it didn't stay down there very long. And if you look at the trough and current levels, they're higher than anything we've seen in the past 5 years. And this chart, I can take you back 10 years on this chart. It's very similar. These are very strong rates and very quick. And you decline and bounce right back up. If you look at the smallest ships, the handy sizes, these are even stronger yet. I mean, a little bit of a pullback, the entire cycle is higher than anything we've seen. And this goes all the way back to about 2008. So basically the highest rates in 12 years, even with the pullback, it's nowhere close to anything we've seen in the last 5 years. So if you kind of, take your, I don't say take your eyes off, you should still watch it, but if you don't get distracted as much with Cape size volatility and you look at mid-size and smaller size as sort of the barometer of global demand and health, you'll see that these markets are very, very strong. Finally, a little bit of a niche or nuance for Eagle Bulk is the rising scrubber spreads. Eagle Bulk installed scrubbers on all their ships, which allows them to burn this higher sulfur, nastier fuel. The scrubber cleans it up, and so they're compliant. Well, this allows them to buy cheaper fuel. So they're saving between $2,000 and $2,500 per day in daily profit. That adds about $3 per share per year in profit, and that's huge for a stock that trades around 40. And you can see this happened recently. The spike started in October. This is like Q4 results, Q1 22 results. It hasn't been reflected yet. You can see that the scrubber spreads were decent throughout the first 3 quarters, but they're really starting to spike right now. All right, the last segment we'll talk about is tankers. Tankers, we believe, are a deep value recovery play into next year, into 2022. As early as April this year, we were on record saying, we were hoping that we could see a recovery by the end of 21, but it doesn't look realistic. COVID's hanging around longer than we thought. OPEC is being way more restrained than we initially thought. There hasn't really been enough demolition of tonnage yet. We're not that optimistic. Then Delta hit, and it was just like obvious that tankers weren't going to recover. It doesn't seem like a lot of other people in the market were paying attention or got that memo, because it seems like a lot of people actually thought tankers would recover this quarter. They obviously haven't. The stocks have sold off because people are throwing in the towel. They're getting bored. It's dead money. We think that's weird. I mean, this is the time that we would be buying. And when I say we, is Value Investors Edge, we would be slowly starting to accumulate and maybe even starting to load the wagons in tankers right now. We think mid to late 2022 is the strong recovery. We think right now is kind of the a little bit of the pivot point. I think we're past the worst of it. And the reason why is because we have the oldest fleet balance in modern history in front of significant regulatory changes. So we have a lot of regulations that force out the old ships, and the fleet's pretty old. So you force those old ships out, you're going to have a very, very skewed supply-demand balance. Our top pick in tankers is International Seaways, a U.S. listed, U.S. management. Lois Zabronki, CEO, and Jeff Pribor, CFO. They've been doing a great job. There's a bit of an overhang on the stock. I think it's all gone now, but they did a merger with another company, and I think a lot of those insiders were selling earlier this year. Plus, I mentioned folks have thrown in the towel on tankers. Other firms, DHT, Euronav, Frontline, Scorpio, and TK. Just 2 quick charts here. I mean, it sums it up quickly. I kind of borrowed these, stole these from Euronav. They have great charts, but the left side here shows the oncoming supply, And so 2022, this is by quarter. 2022 is kind of a normal year, a little bit low on average, not normal. 2023 has very little, almost no supply coming. And I mentioned how good container ships are. Well, everyone's rushing to order container ships and LNG ships and that sort of thing. Nobody wants to order tankers because the market's not very good. Well, if you ordered a tanker today, the soonest I believe you could get it is mid to late 2024. So this is basically fixed and locked in. So by the time we believe a recovery is going to happen in Q3 of next year, 2022, folks are going to say, oh, we need to order tankers. Well, by that point, it's going to be a 2025 order. You're going to have a similar setup to container ships where you just can't get new ships for 2 years. And you can see that here. Euronav points out it's the lowest level of ordering since 1995. That's on a nominal basis too, not even percentage basis. April had some orders, 8 tankers, but really nothing since. And we haven't really seen anything in November or December either so far. This is the fleet balance. I mentioned it's the oldest basically in history. Everything in the blue is obsolete. Most of the major companies won't even deal with these tankers. They're basically just doing like sketchy stuff like Iran sanctions, Venezuela, things like that. The stuff in the red are the things that I believe and Euronav predicts will be obsolete in the coming 3 to 5 years. So this is gone. This is getting pushed out and there's not much new supply coming on. So supply is going down. If demand keeps up its part of the bargain, we're going to see extreme rates, I believe, by 20, if not by next year, definitely by 23, we're going to see extreme rates if demand keeps up its part of the bargain. So to review our segment picks and our overall top industry pick, it's a bit of a special situation today. For container ships, the Naus Corp, dry bulk, Eagle Bulk, and tankers, International Seaways. I should mention I'm long all these names. I both invest and trade in shipping, eating my own cooking, but obviously disclosure that I am talking in my book. Today for our top pick, it's a bit of a special situation. I don't think it's ever happened before where I've had a money show and it's like the day of there's a special situation, but this one is Zim Integrated Shipping, ZIM. We expect their earnings to be $12 to $14 per share in Q4. So Q4 is basically done by now, just we reported in February. About 10 to 12 expected for Q1, probably reported in May. So we're looking at 22 to 26 in earnings for the next 2 quarters. The company's net debt free, no traditional debt. And we believe they have current cash of about $30 per share. So they got $30 per share in cash and they're doing like 22 to 26 in earnings in the next 2 quarters. So, I mean, rudimentary math, but you just add those together, that's 50, 52, 56 right there. They're earning $100 to $150 million in free cash flow every week. It's about $1 a share. The stock trades today like $54. So it basically trades at break even for middle of 22. It's crazy, especially when you think back to that freight chart I showed you, right? I showed you that it had barely declined into December. And we talked about how 22 could be as good or better than this year. So I can't even believe how Zim's trading. And I'll tell you, one of the reasons, it's a rumor, and that's why I say special situation, bit of a rumor. But the rumor is that there's a massive secondary from the restructuring bank, Deutsche Bank. Deutsche Bank helped these guys restructure almost 10 years ago. In exchange for that restructuring, they got a bunch of equity, common shares. Well, Zim IPO'd early this year, and Deutsche Bank was on lockup. They couldn't sell it all until September. So they've been ready to lock in their gains. I mean, they've made, I don't even know what their cost basis is. I would say it's like $2 or $3 per share, maybe $4. So they're up 10, 15x on this position. They've been waiting to sell for a long time. There's been this big overhang. Well, the rumor is they sold out completely yesterday, or at least sold a large share. We haven't seen an official filing yet, still a rumor. But if that's true, that means the overhang's gone on Zim, which is remarkably bullish for trading. Today is by far, I believe, a load the wagons type day on Zim. But our fair value estimate is $80. I think it's very conservative. That's really just current cash and excess earnings through like the middle of next year with a little bit of residual value for the company. I believe it's pretty conservative. That's 48% upside on Zim. So I was worried I'd run a little long-winded, so I think we only have time for a few questions, but I'm happy if you tweet at me. I'm happy to answer a couple of them. Also, we have 2-week research free trials available just for 48 hours. So jump on today or tomorrow and take advantage of that. That's at mintzmeyer.com. So again, thanks everyone. I do want to take at least 1 or 2 questions, but I realize I ran a little longer than I thought I would.
Hey, thanks, Jay. That was a great presentation. Quickly here, Rich is asking, great analysis. What's the bear thesis for Zim?
Yeah, great question, Rich. The bear case thesis for Zim is basically that the freight rate party's over, that supply chain is truly easing, that the party's over, that rates are going to plummet, they're going to crash. And then you say, well, okay, Zim has $30 in cash. We already know the next quarter or two is going to be good. Maybe they make another $10, $15. 30 plus 15 is 45. Maybe they don't really make any money after that because the party's over. So I think the bear thesis is reasonably, maybe 45, $50. It kind of party's over is that thesis. We think that's wrong. I don't think the party is over at all. I think 22 could be almost as good as 21. Some people think better. I don't think it's better, but I think it could be similar.
Alrighty, thank you. Could you please comment on the niche market of feeder owners, operators, and regional routes?
I'm imagining you're talking about container ship feeders. There's also small ships in the other sectors, but if you're talking about container ships, it's a very interesting market. There's a lot of intra-Asia trade going on there. There's also growing trade in Latin America and parts of Africa. One of the niche feeder companies actually traded in Norway. It's called MPC Containers. I have a long position there. We also like a company called Global Ship Lease, GSL. They have exposure there. Yeah, I'm bullish on the feeders. I really like the midsize. There's big future supply order book. And we're talking like mid 23, 2024, 25 kind of order book, but it's almost all in the larger ships. So that the feeders are very interesting. MPC is in Norway and Oslo, and GSL is in the United States if you're interested in those markets.
All right. Well, that is all the time we have for today, but thank you very much, Jay. We appreciate your time.
Hey, thank you.
And thank you to everyone for joining us as well.